a strong product is only the starting point for a crypto company. The bigger challenge is getting that product into the hands of the right users, building adoption, and creating a path to sustained growth. This guide covers the core decisions behind a crypto GTM strategy, from customer definition and growth motion to liquidity, platform risk, and measurement. Many crypto projects fail with a real differentiated concept and genuine demand. Superior technology alone does not guarantee adoption. GTM execution determines how effectively a product reaches users and turns that demand into sustained adoption. Uniswap and Aave are useful examples. Both built strong products and developed a sequenced path to get those products into users' hands. Distribution also determines where value gets captured. The layer that owns the user relationship usually captures more value than the layer providing the underlying execution technology. Phantom captured swap volume by embedding a native swap button at the wallet layer. Jupiter expanded from an aggregator into wallet and RFQ infrastructure. Pump.Fun moved from a launchpad frontend into owning its own DEX. The common thread is ownership of the user relationship. There are 7 core decisions in a crypto GTM strategy. Start with the target customer and value proposition. Then define the growth motion and channel strategy. From there, structure pricing, evaluate liquidity, and consider platform risk. These decisions shape how the product reaches users and how that growth can scale. The first decision is identifying your ideal customer profile. In crypto, the focus shifts from who users are to what they do on-chain. That means looking at behaviors such as minting, staking, and swapping. Your audience may include DeFi natives, developers, institutions, or consumers. Each group has a different reason for using crypto, so the GTM strategy needs to reflect those differences. The next step is making that ICP more specific. A useful framework has 3 levels. Level 1 is the category, such as DeFi users or institutional traders. Level 2 looks at behavior, including chain, protocol category, position size, wallet age, and transaction frequency. Level 3 focuses on the trigger that causes the user to act. A working ICP sits at level 2 or above. That gives the team a behavioral definition it can use for acquisition and segmentation. Once the ICP is clear, the next decision is the offer. For DeFi products, the value proposition can include yield opportunities, composability, and permissionless access. The messaging should then match the audience. DeFi natives will respond to technical specifics and composability. Consumers need a clearer explanation of the benefits. The offer and the audience need to line up from the start. The next question is where those users come from. Think about the funnel in 3 stages. Top of funnel brings in new users through paid, organic, referral, or partner-driven channels. The middle of the funnel turns that visitor into a wallet connect and then a completed on-chain action. The bottom of the funnel focuses on turning that completed action into a retained active user. For crypto-native distribution, crypto Twitter or X, Discord, and DeFi forums and communities remain important channels. Pricing is another core GTM decision. Crypto products commonly use usage-based fees, freemium models, or protocol revenue. Uniswap activated a protocol-level fee on swap activity across V2 and select V3 pools. Zerion runs its core wallet and portfolio tracking product free with a paid premium tier for active traders. Lido charges a 10% fee on staking rewards, split across node operators, the DAO treasury, and an insurance fund. The right model depends on how users receive value from the product. Liquidity is part of GTM for protocols where users need to trade or move assets. Scaling acquisition before liquidity can support the promised experience, creates bad slippage and churn. So teams need to monitor several things: organic versus incentivized liquidity, liquidity depth and utilization, retained liquidity after incentives, provider concentration, and slippage at representative trade sizes. Acquisition and liquidity need to scale together. Platform selection creates another GTM consideration. When the entity operating a chain also operates the biggest apps on it, misaligned incentives can follow. That creates platform risk for applications building on the chain. Neutral chains, such as Ethereum and Solana, carry less platform risk because the entity governing the chain has no competing app to favor. Platform risk should be part of the deployment decision from the beginning. Once those core decisions are clear, the next question is the growth motion. Crypto startups can use 5 main approaches: product-led growth, sales-led growth, community-led growth, ecosystem-led growth, and hybrid approaches. The right motion depends on the product, customer, and type of distribution the company needs. Product-led growth works well because users can experiment with protocols without needing permission. The key is minimal onboarding friction, a clear and immediate demonstration of value, and viral mechanics. Sales-led growth is more relevant for B2B crypto infrastructure, custody, compliance, and enterprise wallet solutions. That motion relies on direct outreach to close larger deals, often with longer implementation cycles and compliance approval. Community-led and ecosystem-led growth use a different distribution model. Community-led growth builds an ecosystem where active community members become advocates. Gitcoin's grants program is one example, turning community members into active contributors and ecosystem advocates. Ecosystem-led growth uses wallet overlap data between your protocol and adjacent protocols to identify high-intent users. It can create a distribution channel that requires no ad spend. Some crypto companies layer multiple growth motions together. Chainlink combines a strong developer-focused community with a targeted enterprise sales team. Aave pairs its community-driven protocol with products aimed at institutional clients. The most durable growth strategies often combine motions that support different parts of the market. On-chain data adds another layer to the GTM strategy. Wallet holdings, DeFi interactions, and protocol activity are all visible on-chain. When that data is combined with Web2 data, teams can build a more complete user profile and measure the true ROI of marketing efforts. The operational layer can include real-time dashboards, automated insights, and no-code tools for building audiences. There are also several common GTM mistakes. Launching incentives before validating recurring value. Optimizing for wallet count rather than retained users. Treating community size as product adoption. Scaling acquisition before fixing onboarding. Using one message for every wallet segment. And measuring transactions without measuring revenue or retention. These gaps can make growth look stronger than the underlying product usage. The metrics should follow the user journey. Start with acquisition, including wallet connects and first transactions. Then measure activation through meaningful on-chain activity, such as a swap or stake. Retention looks at return usage and transaction frequency. Revenue measures transaction volume and fees generated. Crypto teams should also track metrics such as total value locked and active wallet addresses. Attribution becomes important because crypto user journeys are harder to follow. Users are pseudonymous, interact with multiple protocols, and often use several wallets. That makes campaign measurement difficult. On-chain attribution connects marketing touchpoints to on-chain outcomes. This gives teams a way to measure the true ROI of their marketing efforts. GTM performance also depends on product market fit and user experience. Crypto. GTM failures are often product market fit or UX failures surfacing downstream. The best GTM execution cannot save a product the market does not want. Poor UX creates a leaky bucket where users arrive and leave before completing the core action. A product with real PMF and solid UX still needs distribution so users can find it. The 40% rule is one useful PMF signal. If 40% or more of active users would be very disappointed if the product disappeared tomorrow, that indicates strong product market fit. The key takeaway is that deliberate GTM separates crypto projects that reach sustained adoption. Start by defining your ideal customer profile based on on-chain behavior, aiming for level 2 or above. Choose one primary growth motion before adding complexity. Confirm liquidity can support the experience you're promoting before scaling acquisition. And instrument the full journey, from acquisition source and wallet connect to successful transactions, retention, liquidity, and revenue. That gives the team a foundation for scaling each channel with better data. the goal is to measure what matters on-chain. Formo makes analytics and attribution simple for DeFi apps. Book a demo, formo.so/demo.